Okay, we are talking about debt service funds right now. So, we already talked about how a city or state might issue a big bond issue to pay for something really expensive, right? Like you're going to build the harbor bridge, you're going to have to issue some bonds. You can't come up with that out of pocket, maybe. So, you issue some bonds, and once you have these bonds outstanding, right? It's a debt. You're going to have to pay people back for the bonds. You have to pay them interest every year. Or every 6 months, or however they work. And at some point, you'll have to pay the bonds off, right? So if you borrow $30 million in bonds for 30 years, at the end of that 30 years, you've got to have $30 million to give those people. So you're probably going to want to save that up a little at a time, $1 million a year for 30 years, instead of all at once. Or issue some new bonds to pay it off, something like that. But in order to make sure these debts get paid, I'm talking mostly about bonds, but sometimes they borrow from big consortiums of banks. It just depends on how much they need. So we got a debt service fund. So they account for financial resources that are restricted, committed, or assigned to expenditure for principal and interest. So they repay debts. Principal or interest, whatever it is, you put that money in that separate debt service fund and it gets used for that. Alright, so that's a debt service fund. Why do we use them? Well, sometimes we set them up as sinking funds. So just like a corporation might set up a sinking fund to retire a bond or to set up maintenance fees. You know, if you're a corporation and you have very large capital assets, you have like your Ford Motors, and you have large plants and lots of equipment and stuff. You know, you're going to be spending millions of dollars at some point to repair, replace, maintenance. So you might set up a sinking fund and put a little separate aside, and pay off your bonds. Like I said, $1 million a year for 30 years instead of 30 million all at once. Sinking fund. That's what we call that. It's a sinking fund. It's set aside to just sink the money into until you need it, so you don't drown at the end or something like that. I don't know where it got the name from. Payments on long-term notes. So obviously, if you have loans rather than bonds, you probably have to make payments monthly, semi-annually, annually. Just depends on how it's set up, but you'll have payments that include principal and interest. And if you have capital leases, so a lot of cities are going to have leases for equipment. The electrical trucks, the fire trucks, even some buildings, they may lease space in some offices, so they might have capital leases, and that's kind of considered debt service, even though technically it's not a liability, I guess, but it kind of is. Alright, so it accumulates the resources to pay back principal and interest. So if it's for principal and interest or capital lease, you set that money in there and use it for that. Alright? Now, not for a proprietary fund. So remember, if the water department is going to build a new water treatment facility and they're going to issue a bond to get some money to do that, that's going out in the proprietary funds. Alright, so the debt service fund accumulates the money to be used for the expenditures, but it's not a liability account. So the debt service fund is not a liability account. So it uses modified accruals, which basically means you recognize the expenditure when you make it. We don't accrue interest, so probably when you first learned about interest and notes, you learned that on December 31st you do an adjusting entry to accrue interest because you have to expense that interest in the proper year. Well, you don't if you're a government. You just say, I'm paying it this year, so I'm expendituring it this year, even though I may be accrued 9 months worth of interest. So let's say I'm a government and I borrowed money and I'm going to pay it back in a year with interest. Well, on December 31st, if I owe 9 months worth of interest on that, I'm not going to accrue it as interest expense. We don't have expenses. We have expenditures, and I haven't expended anything. So if I'm not paying that for 3 more months, it's just the whole thing is just an expenditure in the next year. That's modified accrual. All right, so not a big deal. Now, if it's coming up really soon, like let's say it's December 31st, and you're like, oh, I'm not accruing interest. You can accrue interest, but you don't have to if you're going to pay it like within the first month there. All right. So, and of course, these bonds liabilities go in the government-wide stuff. It's not a liability in the actual fund itself. All right. Where's the money to pay for these debts come from? Well, typically the general fund transfers it over. There could be some taxes that are specific to that debt. You could refinance a bond. You could say, oh, bond's getting ready to come due, but the interest rates are lower. I'll issue a new set of bonds and pay off the old bonds and get rid of those high interest rate bonds. Oh, all right. So the exceptions to expenditures are when the year ends and it's within a month. So typically, you just write down that it's you just record the expenditure when you pay it, right? So or you don't. It's not due until next March. It's December 31st, but you're not going to pay it till next March. Well, interest and principal are recorded when due. That's it. I mean, it's pretty simple. So you record them when they're due, and you pay them, and that's it. You can do an accrual. Types of debt. Okay, so we've got serial bonds. A serial bond is a kind of bond that is paid off not all at the end. So if you enter serial bonds, it's like some bonds will mature in 5 years, some bonds will mature in 10 years, some in 15, some in 20, some in 30. So you're paying those bonds off a little at a time as they go. That's a serial bond. Term bonds, everything's paid off at the end. So these are pretty typical, 20, 30 years. City issues a bond, and then at the end, when it matures, they pay back the principal. They typically pay the interest every 6 months or every quarter, but the whole thing gets paid back at the end. Deferred serial bonds are serial bonds, so they're getting paid off every, let's say, 5, 10, 15, 20, 25 years. So they're getting paid off a chunk at a time, but they don't start paying off for a certain amount of time. So you can imagine a city built something that's going to start earning them some revenue, a toll road, toll bridge, something like that. City builds a toll bridge, and it's not going to make tons of money right off the bat, but they'll have enough money to pay the bonds in, say, 2 years, something like that. And of course, you have to build it first. So, you know, that deferred serial bond gives you time to get some money and then start making your payments. In term bond and deferred serial bond fund situations, the debt service fund is a sinking fund. So you move money in there, leave it there, and then when you have to pay off the fund, then that's when you move that out. Right? So you're moving it in from the general fund and move it out when you pay it. We won't do this in class, but obviously people use present value techniques to figure out how much money they need, right? The future value, right? So they figure out the future value and set aside that money. Okay. Fund definitions. All right. So the last kind of fund we're going to talk about today is permanent funds, and we'll talk about them when we come back.